Evening, everybody. All right, 6:30, let's go ahead and get started. Thank you for your patience last week, and thank you for the emails. Much appreciated. Like I tell my children, family first, and pretty much everything second. And I apologize for missing last week, but family first. And that's just a lesson that I try to teach my own children, and I hope it's something that you will take away from this class as well, that there are just going to be times in life when you got to put your family in front of everything else. So I appreciate everybody's emails and well wishes and understanding. So what I'd like to do tonight is I'd like to kind of start with two things. I want to talk about the data detective simulation, and then I want to talk about the SNS Air Planning for Growth mini case before we get into tonight's discussion around the time value of money. So when we think about the data detective simulation, first of all, it's one of my favorite things to do, simply because it just really puts things into perspective in terms of common sized balance sheets, common sized income statements, and gives you an idea of how ratio analysis can be applied between different companies. And it also gives you an idea that you can't use ratio analysis per se across different sectors, because you can't necessarily compare the asset turnover ratio of an AEP to an asset turnover ratio of a Chipotle. They operate in two very different sectors, serving two very different types of clients. So let's talk a little bit about the data detective simulation. So you were given 8 different companies to try to figure out, all right? And I selected these 8 different companies because they were from 8 different sectors, and they each had kind of like one major ratio, one key ratio that would tip you off that, yep, that's what that company is. And it required you, though, to do some research about the company and about the sector. So company A, for example, was AEP. All right, it's an electricity producing company. All right, it's a power generation company. All right, very, very, very large. They have a lot of fixed assets that are going to have to operate for a very long period of time. Okay, so when you started to look at some of the ratios that went along with company A, some of the ones that stick out would have been long-term debt, right? 30% of their balance sheet was tied up in long-term debt, okay? Their PPE, their net fixed assets, their plant, property, and equipment was 78%, okay, of their balance sheet on the asset side, right? That means they've got a lot of assets that are sitting out there generating revenue. And then you look at their asset turnover ratio, and it was only 0.2, right? So they have to spend a lot of money to build all of these power generation plants, some of which stay idle for a very long period of time if the weather isn't quite warm enough and they have to turn the generation on to power the air conditioning units. Okay, so AEP was company A. So how many of you got Chipotle right off the bat? All right, how many of you picked company H as Chipotle, like as one of the first ones that you picked?
I did.
Okay, Annalise, why did you pick Chipotle as, like right off the bat, why did you pick Chipotle as company H?
Let me pull up my answers really quick. Give me just 1 second.
Okay, that's all right.
I think one of the main things I do remember was that Chipotle has, since they're in the food industry, they have perishable food, so we would anticipate a high inventory turnover ratio.
Yep.
And then I think they also mentioned something about the stock buybacks in addition to retained earnings, which at least to me, it suggested a higher ROE.
Right.
And then I think there was one other thing that it specifically mentioned. Give me just 1 second. I actually think that was probably my main reasoning.
Okay. So first thing you said, inventory turnover, like that was the big key. All right. Chipotle Company H had the highest inventory turnover of 176 times, right? Because they're known for their high quality, very fresh ingredients, very expensive to put those cost of goods sold into the Chipotle restaurants. So you've got a really high inventory turnover and you've got a really high percentage of cost of goods sold as it relates to revenue. So Chipotle was definitely like, should have been like the first one to isolate as Company H. Okay. The second one that, in my opinion, would have been the easiest one to identify as well would have been Company G, okay, which turns out to be Eli Lilly. Anybody have an idea as to why that would have been like the second probably easiest one to figure out?
Well, it had a high R&D, and then the comprehensive income was indicative of the stock repurchasing.
Yep. What you said first is exactly right. And it's supported by the comprehensive income. They had the highest research and development. Eli Lilly, pharmaceutical company, lots of R&D costs, right? Not so much R&D goes into a Wells Fargo or a Marriott. Okay, so Eli Lilly, lots of R&D. Bingo, Company G, Eli Lilly, right? Company E, all right, was Wells Fargo, right? What were some of the red flags, the key factors that were in Company E that would have tipped you off that it would have been Wells Fargo?
They had a very high leverage ratio, which is typical for banks.
Yes, yes, good, Jen. Extremely high leverage ratio of 11.5, right? That's pretty indicative of banks. What else?
They didn't have inventory, so you knew it was services.
Yes, good job. No inventory, all right? Another key variable there, no inventory. What else?
Also, I know I messaged you about this, but the cost of goods sold, since they're a transactional company, you would expect either low or no COGS.
Right. There's no cost of goods sold, right? It's all financial services. There is no cost of goods sold, right? So that's right. So Company E was Wells Fargo. The next one would have been, it was kind of a toss-up between Company B and Company C, but I'm going to say Company C would have been the next easiest one to figure out, and that would have been Spotify. Okay, so what about Spotify would have tipped you off that it would have been Company C?
The unearned revenue due to the subscription services.
Yes, yes, very, very good. What else?
Kind of going along with that, since a lot of their subscription, a lot of users go on the free model, we would expect to see that their net income would be negative.
Okay, yep, that's a good one. And they have a very, very, very high cash, very, very high cash percentage, right? Because most of them, they get paid on a monthly subscription. So it just gets direct billed and they get the cash immediately. So I think it was like 49% of their of their assets were in cash itself. So that was a really good indication that that would have been a subscription-based company. And then they had no inventory, right? Because there's nothing to inventory, period, with Spotify, right? So that would have been Company C. Company B would have been probably number 5 in order of ease of selection. So that would have been Anheuser-Busch InBev, all right? What would have tipped you off that Company B would have been Anheuser-Busch InBev?
They had a ton of goodwill.
Yeah.
Ton of
from all
goodwill.
for all acquisitions, yeah.
Yeah, exactly, Will. Very good. So like that's like the one ratio, the one metric that kind of tipped you off that, all right, they've purchased over 500 different brands over the course of their lifespan, right? And they're pretty valuable brands, right? People buy beer, all right, a lot based upon the brand, right? And InBev owns most of them. So they had the highest amount of goodwill pretty much out of everybody, right? So that's pretty much, that was kind of the key metric there that gave away InBev. Number 6, we talked about, that would have been AEP, the utility, the long-term debt, the leverage ratios, the very, very low asset turnover ratio because of the power generation units that they own, okay? And then number 7, company F, Southwest. What would have tipped you off that company F would have been Southwest?
I had unearned revenue. If people are booking flights, a year in advance and they don't, realize that revenue until you actually fly it.
Until you actually fly. That's right, the matching principle. That is absolutely fantastic. That is one of the very specific metrics that specifically relates to an airline. Very good. Anything else?
I know
What
they
about-
mentioned about operational efficiency and focusing on the fuel efficient vehicles. So at least for me, I kind of honed in on that and thought that they would have the lower cost of goods sold as well.
Okay. Yeah, so I mean, the fuel cost is like one of the largest expenses that the company is going to have. So that their cost of goods sold relative to other industries is going to be fairly high, right? Because they've got to fuel all those jets. The other thing too is depreciation and amortization, right? It had a like a 6% depreciation and amortization ratio, which because they own the planes, they buy the planes, they should have had a significantly higher depreciation and amortization ratio metric than other industries, as well as their PPE, their net fixed assets. They own a bunch of planes, right? So between the PPE, depreciation, the unearned revenue, and the cost of goods sold, that was Southwest. And then finally, company D would have been Marriott, all right? And Marriott was kind of an interesting one because there wasn't, did anybody find anything that kind of stuck out when they were evaluating Marriott that would have like tipped you off to think that one of the other companies or that Marriott would have been an easier company to identify?
I would say goodwill. That was the only thing, like the brand recognition of Marriott, people having loyalty to a Marriott brand, because of rewards programs and things, but that was the only, that was it.
Okay.
For me.
Anything else that stuck out with anybody about Marriott? Did everybody just kind of feel like Marriott was like the last company left over and that had to be it?
Mm-hmm.
Well, I mean, it also didn't have any inventory.
Yep.
So it's a service company. So then you knew it was either Spotify, Marriott, or Wells Fargo. And it was pretty easy to get Spotify and Wells Fargo.
Right.
So it just kind of left Marriott.
Right. Right. So it was kind of by design that it was done that way, right? Because there really isn't anything necessarily that kind of stands out about Marriott. I mean, it's got some goodwill, it's got no inventory, right? But there wasn't anything that just kind of stood out like the other companies. So the goal here was you basically go through, you isolate what you can, you flag the ones that you know are easily identifiable, and then obviously whatever's left has to be Marriott. So, all right, great. Everybody did a great job on all that. I hope everybody had fun through that simulation. It's more fun in class, I'll tell you that. When everybody's talking and there's more energy in the classroom and we're working in small groups, and it is definitely a lot more fun. But nonetheless, I hope you enjoyed it. Okay, let's change gears and let's move over to S&S Air. All right, and let's talk a little bit about Chapter 4 and how we started to go about planning based upon a percentage growth in sales. All right, and I'm going to go ahead and cut over to my Excel sheet here so I can talk with you directly off of that. So the mini case talked with us a little bit about this guy, Chris, who you became familiar with the ratio analysis from the week prior to last week. And we were talking a little bit about their business wanting to grow a little. All right. What kind of sustainable growth rate? Meaning, if we had to access the debt and equity markets, what could we sustain by using debt and equity to finance our business? Or if we didn't want to finance our business through debt and equity, but we just wanted to use our own existing assets, what does our internal growth rate look like? Okay. So when we start talking about planning and projecting a forecast, an estimate for a future period in time, all right, we're going to call that pro forma, okay? We were given some information around the 2018 income statement and balance sheet for S&S Air, okay? So we were given all of this information, okay? We were given all of this information with dividends and retained earnings. We were given what the 2018 assets looked like and what the 2018 liabilities and owner equity looked like. And the first question was, tell me what the internal growth rate and the sustainable growth rate are for S&S Air for 2018. So I am probably nowhere near as good at Excel as you guys are. All right. So I like to break things down into the components. So I know that the internal growth rate uses return on assets, all right, because it's how much can we grow simply using the things that we have already, the assets that we already own. We don't want to have to go out and buy new stuff. How much can we grow internally using the assets that we already have? So I know I've got to use ROA, okay? And we have this other variable B, all right, the retention ratio. Why do we use retention ratio? Because that's how much of our net income we're keeping for ourselves, okay? That's how much of the money that we've worked hard to make we get to keep to then reinvest back in our business, okay? So that's why we use retention ratio, and retention ratio is that variable B. So when we think about the internal growth rate is nothing more than, right, the ROA times the retention rate divided by 1 minus the product of ROA times B, right? So we calculate ROA as net income divided by total assets, right? We know that our retention ratio is 70%, also known as plowback ratio. How much we keep for ourselves, how much are we retaining, and how much are we plowing back into our business. Okay, so retention, plowback, same thing. And then in Excel, we can calculate the internal growth rate was 7.55%. Okay, so using the assets that we already have and the retention dollars that we're plowing back into our retained earnings, okay, we can reasonably expect to have an internal growth rate of roughly 7.5%. Okay, so we could grow at a rate of about 7.5% consistently year after year, simply by using the assets that we have, as long as we maintained the 2018 performance. Okay, so if 2018 continued at, this way, ad infinitum, right? We could reasonably achieve an annual growth rate of about 7.5% without having to go out and access the debt and equity markets. The sustainable growth rate, though, uses the return on equity, okay, which is a measure of leverage, right? So how much can we grow if we use the other things that we've got at our disposal, okay? The retained earnings, the common stock, okay? So when we think about sustainable growth rate, we're no longer looking at return on assets, we're looking at return on equity. So return on equity is nothing more than net income divided by our total equity for that given year. And when we do that, we see we've got a return on equity for roughly 17.6%. Retention ratio, the same. And sustainable growth rate is the same thing as internal growth rate, except we substitute ROE from ROA, right? So we put ROE in the place of ROA, and we get the sustainable growth rate. So if we access the financial markets, okay, if we use the money that we've accumulated since the beginning of time with our business, okay, and we access the debt markets potentially, we could possibly achieve a sustainable growth rate with leverage, okay, of approximately 14% within our business. Okay. So the real question now becomes, if we think about it, the growth rate that we were thinking in this example, based upon the projection that Chris and who was it, Matt, Mark, and Todd, right, we're talking about, was 12%. So is 12% a reasonable growth rate for S&S Air to consider as they move forward? Well, 12% falls in between the internal growth rate and the sustainable growth rate. So what that tells us is that we know that we cannot sustain a 12% growth rate simply by using the current assets that we have, right? Because that is the upper bounds of what we can do. 7.55% is the growth rate that we can reasonably achieve simply by using what we've got, right? And the sustainable growth rate is kind of the maximum growth rate that we could possibly achieve considering the leverage scenario of our balance sheet, right? So if we're at 12%, we're fall in between the IGR and SGR, which tells us that 12% seems like, based upon our current debt and equity, our current leverage situation, we could achieve a 12% growth rate by accessing the financial markets to help us support that growth, okay? If the growth rate was above the sustainable growth rate, right, we might be able to achieve that growth rate for S&S Air in a given year in a very discrete period of time, but it's not sustainable, okay? So it's not something that we could consistently count on achieving based upon our existing leverage situation. We could change some things about our leverage that might impact our ability to adjust our SGR higher, right? So if we had a higher ROE, okay, a higher return on equity, okay, then we could achieve a higher sustainable growth rate. What's one of the things that we could do, all right, to achieve a higher sustainable growth rate? What's one of the things operationally we could do to achieve a higher SGR?
Cut costs.
Cut costs. There you go. I mean, plain and simple. If we cut out costs, if we operate more efficiently, every dollar that we cut out here flows down here to the bottom line, which increases net income, increases the numerator over the same denominator, higher ROE, higher sustainable growth rate. Okay, so when we think about, remember, the DuPont identity, and we start thinking about bringing profit margin into the discussion around return on equity, okay, that's one of the things that we can do, all right? And if we remember one of the other things we can do about return on equity, right? Total asset turnover. If we can increase the number of times that our assets are used to make money for our business, all right, that also increases the return on equity, okay? Further, the equity multiplier, if we get more levered, if we take on more leverage, all right, that helps our ROE as well. So that will help boost our sustainable growth rate, okay? So for question one, the internal growth rate was 7.55, sustainable was 13.95. Okay. Question two revolved around the external financing needed for the business based upon a 12% growth rate projection, okay? So we had 2018 given to us, okay? Now we had to figure out, what does 2019 look like? Okay? So we vary the things that also vary with sales, cash, AR, inventory. So all of these went up by 12%. Net fixed assets went up by 12%. Accounts payable went up by 12%. Notes payable and long-term debt didn't change, right? Because we don't vary those with sales. Those are management decisions as to how they're going to go about financing the business, okay? Independent of sales. Common stock, independent of sales. So it kept constant at 460. Retained earnings, we started 2019 with what we ended 2018 at, and all we did was add to that number what we did in 2019. Okay, so the addition to retained earnings flowed through, right? And when you look at the 2019 total assets and you look at the 2019 total liabilities and owner equity, you can see that they're out of balance, right? They're not in balance with one another. So the external financing needed is the difference between the total assets and the total projected liabilities and owner equity, or 648,346. This means that in order to force the balance, in order to make the balance sheet do what by definition it has to do, and assets must equal liability and owner equity, okay? You, S&S Air, Mark and Todd, have to figure out where the shortfall is going to come from. They need an additional $648,346 of additional financing in order to achieve a 12% growth rate for their business next year. So where are they going to find it? What levers do they have on this side of the balance sheet? What levers do they have to make this difference, this shortfall up? That is a question for the group. What can they do?
Either take on more debt or issue equity.
Okay, they can take on more debt, right? So they can add to their long-term debt, right? Or they can do exactly what you just said. They can issue more common stock into the marketplace, okay, for $648,346. We either got to take this number up or we got to take this number up, right? Because there's not a whole lot we can do about retained earnings. Kind of is what it is. We started the year at this. We added whatever we put in based upon our operations. So it kind of is what it is. So you can either bump up your long-term debt to cover that shortfall, or you can issue more equity into the marketplace in the form of common stock. Could be one, could be the other, could be a combination of both. I will tell you that when we get to the midterm, I'll tell you which one to plug. Okay? So if we needed to plug the balance sheet using common stock, right? Once we calculate the external finance needed, 648,346, all we have to do is just simply add it to the common stock. So plus 648,346, and we're balanced on both sides with a little bit of a rounding error, and our EFN goes to 0. Okay? So the first step when you're creating a projection for the balance sheet is let it stay out of balance. Get the variables that vary with sales put in, get the variables that don't vary with sales put in, get your retained earnings put in based on what you started the year at plus what you added, and then see what the numbers are. The difference is your plug. And then you, as the financial manager, have to then decide, okay, how do we want to plug this hole? Okay. Do we want to take on more debt? Do we want to issue more stock into the marketplace? Do we want to do both? Okay. To make the balancing work. Okay. So on the midterm, this will kind of be some of the flow. You'll be given some data around the income statement. You'll be given some data around the balance sheet for a given year. You'll have to create the income statement and create the balance sheet for the information that you're based on the information that you're given. You'll be told what a growth rate is, and then you're going to have to create the projections for the income statement, the projections for the divs and retained earnings, the projections for the assets, the projections for the liabilities and equity. You're going to have to let everything flow, calculate the EFN, plug either common stock or long-term debt based upon whatever it is that, you know, I tell you to plug, okay? And then you're going to move into ratio analysis based upon the new data that you've come up with, okay? So the exercise that you just went through with planning for growth is exactly what you're going to see on the midterm, okay? So that's question 2. And then we move to question 3. And question 3 kind of tested your ability to like manipulate some data, all right? So basically question 3 said, all right, we are going to add $5 million to fixed assets, right? We're not going to take it up by 12%, all right, because it's too lumpy. We know we need to add some money to increase the capacity, the utilization of our line. So Mark and Todd said, we're just going to go ahead and spend $5 million extra dollars on net fixed assets. Okay. So that was kind of step number 1. We took the exact same balance sheet that we had in question 2, but instead of taking the net fixed assets up by the 12% growth rate, we were told that they're simply going to buy $5 million more of net fixed assets. Okay. So the net fixed assets number simply went up from what you had in 2018 up by $5 million for 2019. Okay. What happens from an accounting standpoint when we spend money on net fixed assets? What does the government allow us to do with those assets that we purchased for our business?
Amortize and depreciation.
Okay, depreciation and amortization, right? So you kind of had to make a little assumption here, right? If you're adding to your fixed assets, right, you know that you're gonna have more depreciation, okay? So the assumption here was that if we take the ratio between depreciation and the value of our fixed assets in 2018, and we apply that to the value, the new value of 2019, that should give us a new estimate of depreciation for 2019. Okay, so if we take the ratio between, you know, a little over, just under $2.1 million in 2018 and just shy of 20.4 million of net fixed assets in 2018, we take that ratio and then we apply it to the forecast 2019 NFA of 25,382, then we get an estimated depreciation of just under $2.6 million. Okay, and when we do that, it changes our net income, it changes our retained earnings, it changes our retained earnings on our balance sheet, it changes our nothing else, so nothing common stock, nothing long-term debt. Okay, but then it takes our EFN now from 648, 346 in question 2. Now we need to find $3.5 million basically to fill that hole. Okay, so question 3 was really kind of pushing your brain a little bit to see if you can make that connection between the addition to NFA from capital expenditures and how you then adjusted your depreciation number based upon that increase in NFA. Okay. I've posted this out on Moodle, so you'll have access to it if you want to go back and review what we just went through. But pretty much, if you were able to make your way through this, okay, if you were able to build the balance sheet, and here's the thing, I'll give you a big tip. Make it look nice. I know it's a pain in the ass, and I know it takes an extra 10 minutes of your time to put lines and bold things, but guess what? it's going to make your life so much more simple when you get to the midterm exam and everything is just lined out for you. All right, it's ready to go. It's ready to rock and roll. All you got to do is plug in numbers and everything flows. And your ability to find certain pieces of information, if you make it look nice, is improved immensely. And anyone who is in finance now or deals with FP&A or has to deal with putting together spreadsheets like this, you guys know that if you make it look nice, it's a lot easier to deal with. So save yourself some time and start getting your Excel file set up, because what you see here, okay, is pretty much going to be on your midterm, right? I can tell you right now that the balance sheet, all the variables that you see here, every single one of these variables is going to be on your midterm, right? The only difference between this example and what you're going to see on the midterm is that expenses isn't going to be one line item. You're going to have 2 or 3 line items that kind of roll up into the total expenses, okay? But nonetheless, the math is the exact same. The dividends, payout ratio, plowback ratio, right? Go ahead and start working on getting your file set up. Okay. Right. So again, I've posted this out there on Moodle. Feel free to take a peek. All right. And if you've got any questions, we'll circle back either later tonight after class or whenever you've got time to hook up with me. All right. Okay. So we talked about data detective. We talked about chapter 4, how we go about creating a one-year forecast based upon a specific growth rate, right? And that's great. But in the world that you live in and work in, we're not usually talking about one single year. We're usually talking about 10 years, 15 years, sometimes 20 years, depending upon the business that you're in. So tonight, the slides are posted on Moodle for chapter 5, time value of money, right? And you can read those and review those at your leisure, but I'm not going to use that slide deck tonight. We're just going to spend some time in Excel talking about the time value of money and what it means, okay? Because I want you to get comfortable using Excel as your tool, God's greatest gift to man, to help you learn how to go about determining what the future value, the present value, the compounding of interest looks like, right? So for example, let's just head back over here to a blank Excel sheet. So when we talk about the time value of money, very simplistically, we're saying that $1 today is not worth $1 tomorrow, based upon some given rate of return, some given expected rate of return, some given weighted average cost of capital, some given discount rate. All of these mean the same thing. It's a rate of return that you're expecting to receive for the investment that you put in. Okay, so for example, if we have 3 years worth of time, okay, and in the first year, we decide that we're going to deposit $100. Okay, let's keep it, or $1,000. How about let's put $1,000 in. Okay, we're going to deposit $1,000. And if we keep that money in every year, okay, from a simple interest standpoint, our interest is going to be calculated on that $1,000 every year. Okay, so our principal is $1,000. Okay, and the simple interest that we earn, let's just call it at 10%. Okay, so we're going to earn 10% on our money every year. All right, so at the end of year 1, right, we're going to make $100. Okay, At the end of year 2, on a simple interest basis, we're going to make $100. Okay. At the end of year 3, we're going to make another $100. Right? Okay. So at the end of year 3, we have a return of principal. Right? So we get our $1,000 back. And how much interest did we earn? Interest earned. Okay. Well, we earned $300, right? Right? So our total return is $1,300, right? Does that make sense? We have a $1,000 investment. We're going to earn 10% a year on our investment. We get $100 a year in interest. We're going to put that in the market for 3 years. And at the end of the 3rd year, we get our $1,000 back. We made $300 of interest over that period of time. Therefore, our total return is $1,300. Okay. Simple interest. Okay. So now let's introduce the concept of compounding interest, okay, where the principal year after year gets adjusted based upon the interest that we earned in the prior year. So let's take this same example and let's plop it down here. Okay, and let's do compound interest. At 10%. Okay. So again, in year 1, okay, we still have the $1,000. We still earn 10% on that $1,000, right? We still make $100 in year 1. However, now for year 2, the interest gets calculated based upon the year prior plus the interest that we earned. Okay, so now we're getting 10% on top of $1,100. So now it's not $100 anymore, it's $1,100 times 10%. Okay, so now we get an extra $10 of interest in year 2 because of the power of compounding. All right, and then finally, here in year 3, we get the same thing. It's not $1,000 anymore. We started with $1,100. We made another $110. So we have $1,210 to start with. And now we're earning 10% on top of that. Okay. So now instead of earning $1,300 on a simple interest basis, if we compound annually, okay, meaning our money gets earned, it earns interest once a year, and that once a year, that money gets added to our principal for the start of the next year's interest calculation, we can see that on a compounded basis, we earn $31 more, okay, over that same time frame because we compounded our money. Okay. The beauty of this is how we go about figuring out on a discounted cash flow basis, what is the future value of a cash flow stream for a project that we might be looking to implement? What does it look like in today's dollars given a particular rate of return of 10% or cost of capital or weighted average cost of capital, whatever you'd like to call it, okay? And Excel, the magic of Excel, has this built in for you, okay, via formulas. So when we want to think about what's the future value, okay, what's the future value of a $1,000 investment today over a 3-year time frame at a 10% return, we can do that. Okay? And we can do it simply by going into Excel and typing equals FV. So what is the future value, okay, at a 10% return? It tells you everything you need. So rate is the rate of return, okay, comma, the number of periods of compounding. So we're talking about 3 years, okay. We'll talk about PMT here in just a second, but for right now, it doesn't exist in your world. So we just put another comma. So there's no PMT, payment, okay. And the present value. How much are we depositing today into this investment to get money out in the future, right? And like we talked about the very first lecture, words are important. How much money do we have to put out today, deposit today, take out of our operating account today to get some money back in the future? Excel treats present value numbers as negatives. It sees present value numbers as cash outflow. You are putting money into an investment. So when you're dealing with a equals FV and it's asking for the present value investment, you've got to make it negative. Okay, so in this case, it's negative, all right, $1,000. Okay, and assuming all of my math is correct, bingo, right? 1331 and 1331. Okay, so all of this stuff that took us 5 minutes to do, okay, we did in about 5 seconds using the equals FV formula within Excel. Okay, so when we think about the time value of money in this example was along the lines of how much money do I need to deposit, or how much money do I need, how much money if I deposit today, how much will it grow to at some point in time in the future on a lump sum basis, okay? Alternatively, which is what I was trying to say, is if I need a certain amount of money in the future, how much do I have to deposit today given my expected rate of return in order to achieve that number in the future? Okay, so in this case, we wanted to know what is the future value of my $1,000 investment today, 3 years from now, given a 10% annually compounded rate of return. Okay, so that's the future value. Now, if we think about, and I'm going to cut over to my iPad and I'm going to draw a couple things here real quick so that you can see what I'm talking about. Share a different screen here. Yes, that's one. Hold on, I'm still getting there. It's not working tonight. What's going on? Oh, bugger. All right, well, I'm going to have to go back here. Hold on 1 second. Let me try this one more time. It worked the other day. Hold on. Bear with me. All right, it is not cooperating. I apologize. Oh, bummer, dude. Okay, So I'm gonna have to kind of do this the old-fashioned way. Right? So if it pops back up, I'll be able to cut over here in a second. Okay. So if we think about the future value and what we did here, right? We took the principal, the present value, right? And we multiplied it by 1 plus the growth rate. Okay, so we took 1,000, right, times 1 plus our growth rate, right, to get the next year's principal. The future value of that first year's worth of compounding was the 1,000, okay, times 1 plus the growth rate, which gave us 1,100. So that became our future value. So the future value, and I'm really sorry, this is like really irritating me at the moment that I can't draw, right? So the future value is equal to, and then if we did it again, right? If we did it again for the next year, 1 plus the growth rate, okay? That would have given us the third year, right? Or the second year, right? So when we think about the future value formula, we can simplify it into future value is equal to the present value times 1 plus our rate raised to the exponent of time. Okay, so when we think about it, we have equals, so FV is equal to our present value, $1,000 in this case, times 1 plus our rate, okay, raised to the time period. Right? That is the future value calculation. Okay, so when we think about, in this example, what's the future value of the $1,000 present value investment at a 10% rate after 3 years? That's what we did here. Okay. So I'm going to try this screen sharing thing one more time and see if I can get this to work. Sorry about this. It literally worked this morning. I don't understand. Zoom, David's back. Nope. All right. Oh, maybe I'm on the wrong network. Nope, I'm on the right network. Okay, well, I'll have to come back to that one. Okay. So when we talk about future value, that's kind of what we're talking about. What is the future value of an investment that we make today worth at some point in time down the road, given a particular consistent rate of return? Okay. So in this case, we're talking about annual compounding, right? So we're talking about 1 year, 2 years, 3 years. If we think about the number of possible compounding periods in a year, okay, if we were doing quarterly compounding, how many times a year is that? 4 times, right? Semi-annual, 2 times a year. Monthly, 12 times a year, right? So the number of compounding periods that we have impacts the future value, because it means that we are compounding our interest more frequently the more times during the course of a year or the life of an investment that we achieve the interest on top of more interest. Okay, so in this example, so this is annual compounding. Okay, what about if we did monthly? Okay, and we do the same thing, so equals FV, right? So the compound interest at 10% per year, what do we have to do to the rate to get it in terms of a monthly compounding. If it's 10% per year, what do we have to do to it to get it into a per month basis?
Divided by 12.
Yeah, divide by 12. So we got 10% a year divided by 12, right? Okay. And if we've got 3 years of time and we're compounding monthly, the NPER is the number of compounding periods. So we've got 3 years of time, we're compounding monthly. That means we've got 36 months of compounding periods. So we have to take the 3 years and multiply it by 12 to convert it to monthly compounding, right? We still have no payment, and we're still stuck with a negative 1,000 initial investment. And therefore we have now, based upon monthly compounding, okay, we get an extra $17.18 of money. Okay, so the frequency with which, okay, your investment compounds impacts your rate of return. The more times your money makes money, the more money you're going to make. Okay, so when we think about the future value calculation, right, equals FV. Right? Alternatively, we could say, all right, David, I'm spending all this money on my MBA, and I'm taking time away from my family or my girlfriend or my husband, my boyfriend, my spouse, my partner, whatever. And when this is all said and done, we want to take a nice vacation, okay? And we want to go to the Maldives, right? And that's going to cost us, 10 grand to go and do that, right? So the future value of that trip is $10,000, right? And you're saying, I don't want to risk too much. I'm willing to take a little bit of risk to get some return. And so your return that you think you can get is, say, 5%. Okay. And you want to take this trip in 5 years, right? You're spending money to go put yourself through MBA school. You want to work at that higher salary that you're going to get. You're going to pay off some of your student loans possibly, all right? And then after that, you'll be able to start thinking about your trip to the Maldives. So we got a 5-year time horizon. Okay, so now the question is, what do I have to put in the bank today in order to achieve that $10,000 number 5 years from now at a 5% return? Okay, so what we're asking ourselves is, what's the present value of our investment? Okay, up here we said, what's the future value? I'm putting $1,000 in. What's the future value of this $1,000? Now we're coming back from the other side and we're saying, I want $10,000 in the future on a 5% return over a 5-year time frame. What do I have to put into the bank today in order to achieve that? So what's the present value of my investment today? So PV, right? So just like Excel has a function FV, it also has a function PV, equals present value. And once you open the parens, it tells you what it wants, okay? So it wants the rate. It wants the number of compounding periods. I hate it when it does this. It wants the rate, okay? It wants the number of compounding periods. Again, we have no payment. We're not making monthly payments towards this goal. We're lump summing a deposit into the bank. We'll talk about PMT in a little bit, right? So we have no payment. And what's the future value? We want $10,000 coming back into our life, okay? We want to get it out of that investment. So Excel views future value as a positive number. So we can just plug that in right there. Oops. Okay, right there. Okay. So why is PV negative? Because Excel says you've got to deposit right now out of your life $7,835.26 into some investment vehicle that's going to earn 5% a year over the next 5 years to get you to 10 grand. Okay, so the present value of this scenario is saying, if you want to hit 10 grand in 5 years at a 5% growth rate, okay, then you need to deposit today $7,835.26. Okay. So we've talked future value. We've talked present value. So I can tell you on your midterm, there'll be a question around exactly that. What's the future value of an investment today? There'll be a question around present value. How much do I need to deposit lump sum today to achieve a certain goal in the future? Right? When we looked at that formula for future value and present value, which you can see in the slides when you go review them, FV equals PV times 1 plus the rate raised to the time period. You can see that there are 4 variables: future value, present value, rate, and time. Okay? So just like Excel has formulas for future value and present value, it also has formulas for the rate. What rate of return do I need to get on my investment in order to achieve some amount of money in the future? Okay. Your business, your company, looking at making a big investment into the natural gas power generation sector, and then know that they want to build a new natural gas generation facility 10 years from now. Okay. And the expected project cost for that NG generator 10 years from now, $2.5 million. Your treasurer and your CFO sit down and they've decided that based upon their current financial situation, that they can allocate right now, they can allocate $1 million specifically earmarked for that project that they're going to put into an investment that's going to be left alone for 10 years. Okay, the present value. Okay. Now, what we want to know is, that's great. We got $1 million to invest. We know we need 2.5 in 10 years. What rate of return do we need in order to make that happen? So in Excel, there's a equals rate. Okay. And we can look at the number of periods. So 10-year annual compounding. There's no payment. We have an initial commitment of $1 million. Okay. Oops, sorry. Remember, negative PV. Okay. And we know we want that to grow to 2.5 million in that 10-year time frame. Okay. So based upon those numbers, we've got 10 years before the project comes upon us. We forecast that in 10 years, the project is going to cost $2.5 million. We have $1 million today that we can earmark as capital for that new natural gas generation system. Okay. What rate of return do we need in order to make that happen? Well, we need a 9.6% rate of return. Okay. And this is where the conversation starts with you as financial managers. Can I go out into the marketplace right now and can I find an investment that's going to deliver 9.6% per year? Is that even possible? Okay. And if it is, great. If it's not, you rethink your scenario. Okay. So we've got FV, so future value, lump sum initial value, what rate of return do I need? And then finally, the last variable is time. Okay. So let's say we have a future value that we're looking for. We're going to be, let's buy a house, right? We want to be able to put down 20% on a home. So we know we're going to need, and we want to buy a nice home. Let's say we want to buy $1 million house. We need $200,000 of future dollars. Okay. Okay. And at the moment, okay, we have currently in our savings account, okay, $50,000 that we're willing to put into an investment, right, to accomplish this goal. Okay, we have $50,000 of today's dollars that we're willing to put into this investment to accomplish this goal of putting $200,000 down on our house in the future. Okay, we estimate that we can get a rate of return conservatively, because we don't want to lose too much money, all right, of 6%. Now the question is, I got 50,000 to put in. I want 200,000. Okay. I got a 6% rate of return. How long is it going to take me for this $50,000 to grow to be $200,000? Okay. So how many compounding periods is it going to take for me to get there? So what we're solving for is the number of periods. So time. And just like we saw in those variables within the parens, we know now that the formula in Excel for the number of periods is equals NPER, N per. Okay? And it asks for the rate. Okay? We have no payment. We know that we have a present value that we're willing to invest of 50,000. Okay? And we know that we want to achieve a goal of $200,000 in the future. And when we do this, it tells us that at that rate, if we simply put $50,000 in the bank and it earns 6% a year, it'll take us 23.8 years to achieve the goal of $200,000. Okay, so future value equals present value times 1 plus the rate raised to the time period. Okay. 4 variables: future value, present value, rate, and time. Excel has formulas for each one of those 4 variables. Equals FV, equals PV, equals rate, equals NPER. Okay. Be careful of your signage. Remember, Excel views present value as dollars going out the door. So it's got to be a negative. You're putting money into an investment. It sees future value as dollars coming back in after you've put your money into that investment. So the future value is positive coming back in the door. Okay. So I want to try to get this screen shared here because I want to go into this next piece. Are there any questions about those 4 different Excel functions and how they work? Oh, hey, there, it's working now. Yeah. Okay. Of course it's not working. It shows up, but it's not working. All right. Okay. All right, so let's translate this into S&S error and what all this means. Okay. So I want you to think about that future value formula. Okay. Future value equals present value times 1 plus r raised to the t. Okay. And think about how we can split that apart into 2 pieces. So future value equals present value times 1 plus r to the t, two different components. And if we're trying to figure out what some future cash flow stream from a project looks like in today's dollars, okay, we have to rearrange that formula and solve for the present value. So we have to move the 1 plus r to the t to the other side, to the denominator. And now we have present value is equal to the future value divided by 1 plus r to the t. Okay. And let's take that one step further. So now we've got present value is equal to future value times 1 over 1 plus r to the t. Okay, so we have, if I can do this here properly, and this sucks, and I really apologize, and I wish I could get it to do something different, but it's not working. Okay, so I'm gonna have to draw with my dang mouse here. Okay, so we have, now what we've got is the present value is equal to the future value divided by 1 plus r to the t. Okay, right? So let's split this apart. So this is also the same thing as future value times 1 over 1 plus r to the t. Okay, I promise my handwriting is better in person. Right? So this is all the same stuff. So if we want to know if a project is going to generate $1,000 of money 10 years down the road, we want to know, what does that $1,000 look like in today's dollars? Okay, so we take the future value, the $1,000, and we multiply it by this factor, 1 divided by 1 plus the rate to the time period, so 10 years in the case we were just talking about. Well, this whole thing, right, that's called the discount factor, right? So the future value times the discount factor gives us the present value of that future cash flow stream. Okay, so the present value at some point in time in the future is equal to the future value at that same point in time in the future times 1 plus your discount rate to the time period that we're talking about. Okay, so let's think about this in the context of S&S error. Okay, so we saw that S&S error, all right, in 2019 generated $2.85 million of net income, okay, on $51.9 million of revenue and all the other costs and expenses that came along with it. How do we go about now projecting, okay, what the impact of a particular project might be on S&S Air's revenue stream if they decided to implement the project that they were considering? Okay, how do we start going about evaluating whether it's beneficial, okay, to spend those dollars today to create a future stream of cash flows? Okay, so we're going to start looking at building the 10-year pro forma for a given project for S&S Air, right? So when we start thinking about the different variables that we have to consider, right, what we're trying to figure out is, how do we go about making a 10-year estimate, right, for how this particular project that we're evaluating, okay, how is it going to impact the revenue stream and the cost of the business, depreciation, any additional interest costs, right? How is the project, the incremental revenue that the project is going to deliver to the business, okay? Because you're looking at spending money, and for the money that you're looking to spend, you want to get something in return for it, generally in the form of higher revenues, lower costs, more net income, okay? So what we have to think about is we've got a number of different variables. How much is the project costing us? Okay. How much more revenue am I going to get just as a result of this particular project? How much additional cost is going to be added to my income statement because I'm putting this project in? Okay. What additional depreciation am I going to experience by having added $2.5 million of capital money into the business? Okay. Am I taking out any debt? Am I going to have additional interest as a result of this particular project? Okay. So those are the different variables that we have to consider. So in the case of S&S Air, just like we worked on the sales growth projection for one single year, we're doing the same thing here just for 10 years, but we're doing it on an incremental basis, okay? So not on the new total based upon the additional 5%, but what's 5% of the revenue? Okay, so this project, all right, if we decide to do it, would generate an incremental $2.6 million per year of revenue to S&S Air if they chose to do the project. Okay, all right. We know that cost of goods sold is related to sales, so we can go ahead and we can adjust the sales up, right, by the same amount. So we can take the cost of goods sold that we had in 2019 and we can add 5% to it. Okay, so this project is going to add an additional $1.9 million of cost of goods sold, leaving us with an additional $658,000 of gross margin added to the business because of the project. Expenses, it tells us additional costs of 3%. So we know we get an additional 3% of cost. Okay. So now we've got an additional EBITDA. Depreciation, an additional $250,000. So we know that it's just simply $250,000. EBT, oops. EBIT, $211,366. Interest, additional interest of $150. Okay. EBT. Taxes, net income. Okay. All right, so in year one, if we decided to do this project, okay, we would be adding $46,000 to our bottom line. Okay. And now, because the project is going to deliver the same amount of revenue, the same amount of additional cost, the same amount of additional depreciation to create the 10 years, all we have to do is simply link back okay, and then drag it. Okay, so now we've just created a 10-year pro forma based upon a $2.5 million potential investment and what the project was expected to deliver incrementally for the business. Now, in your businesses, your lines of work, I'm going to tell you right now, this is about as overly simplistic as you could possibly get, okay? But the concepts are the same, and the concepts are very, very applicable, all right? If you're working for Exelon, you know what? You've got so many more assumptions. You probably got 2 pages worth of assumptions. What's the forward curve for natural gas? What's the forward curve for oil? What's the forward curve for uranium? What's the forward LMP price? What's the forward curve for crude oil? Okay, you've got a ton of different assumptions. Bottom line though is it gets built the same way. Okay, so now we can see, all right, that we've got a future stream of cash flows that we need to figure out what is that in today's dollars. All right, how do we think about in 2029, what's the value of $46,000 in 2029 back in today's dollars? Okay, so this is year 1. This is our base year, 2019. This is what we're operating off of. Okay, so we want to figure out what is, first of all, what's our operating cash flow? Okay, and what we talked about at the beginning of the semester was operating cash flow is nothing more than equals EBITDA, okay, minus taxes. Okay, because we care about cash. And that's what we really want to know. How much cash is this project delivering to our business? Okay. So we know that we know that we're getting about $446,000 a year in, let's call it free cash. All right. We haven't talked about the impact of a change in net working capital and the additional capital expenditures right now. We're simply talking about pro forma income statement. We will get to true free cash, bringing in the impact to the balance sheet when we start talking about the Heritage Doll case next week.
Hey,
Okay.
Professor.
Yes.
I have a quick question. 2020 going forward to 2029, like if you're looking at sales, for example, it's only showing 2.5 million. Wouldn't you do times 1.05 to show the growth?
So I'm keeping it super simple because yes, depending upon the project, you could have compounded growth every single year. Okay. In this example that I'm going through right here, just to keep things simple, it was simply going to be a 5% growth on the base year kept constant for 10 years.
Gotcha. Okay.
Okay. So I am not going to like throw a curveball your way on the midterm and ask you to do that compounded growth where you're getting an extra 5% every year, or even go so far as to test you on the fact that when we said we were going to get 12% growth, to roll this out for 10 years and then add 5% on top of all of that. Not going to do that.
Okay, thank you.
Okay, it's the whole purpose of this class is to get you exposed to creating a pro forma statement using a growth methodology. And again, your companies are going to do things totally differently. You might have a cyclical growth rate where for the first 3 years it's going to be a 10% compounded growth, and then it's going to taper off for a couple of years. Then you're going to pump CapEx in out here in 2026 to get the growth rates back up, and you could have a higher growth rate out the curve. It's every single DCF analysis is different from one another, and it's going to be different from company to company. So my point here is to just simply get you exposed to building a 10-year pro forma, keeping it simple based upon a base year, and then doing the discounted cash flow analysis after that. So I will say this, if you are working and you are currently doing some discounted cash flow valuations and you'd like some help, you'd like some guidance, I am more than happy to sit with you offline and talk with you about that. I love it. This was one of my most favorite things to do in finance was DCF analysis. All right. So back to this example, right? Keeping things super simple. We had a growth rate based upon a base year that we kept constant for 10 years. All right. And this is what you're going to see on the midterm. I'm not going to make it any more complicated. Right? So now we have an operating cash flow, and obviously it'll be the same throughout the course of all 10 years, right? So now we have to figure out what's the discount factor. Because our ultimate goal here, right, is to figure out what's this $446,000 worth to me in today's dollars, right? Discounted back into today's dollars, what would I have to deposit today at an 8% cost of capital rate of return? What would I have to deposit today in order to get $446,000 10 years from now? That's what we're trying to figure out. Okay. So remember, our discount factor was 1 divided by 1 plus the rate to the time. Okay. So how do we go about doing that? Well, we use the magical gift from God, Excel. Equals 1 divided by 1 plus our rate, which we are given as cost of capital, 8%, okay? Raised to the time. Anybody have it? How are we going to figure out the time? What's the time period? What's the formula? How do we do this? While you guys are thinking, ever go glass blowing? I just made this glass like 2 weeks ago. McFadden Art Glass over off of 95 over on the Sparrows Point side of town. Great place to go. So how do we find the time? If we're going to build this in Excel, how do we determine what year we're in? So all we have to do is click and drag, and we set up one formula, and then we just copy it for 9 more years. Well, how about we open parentheses for one thing, right? And we know what year we're in, right? And we have a base year of 2019, correct? Okay. But we need that base year to be fixed because I want this to be year 1. I want 2021 to be year 2, and then so on and so forth. So I have to fix it. Okay. And now all I have to do is drag it. Okay. So now I've got the discount factor for all 10 years. Okay, remember, present value equals future value times 1 divided by 1 plus r to the t. And 1 divided by 1 plus r to the t is the discount factor. So the present value is equal to the future value times the discount factor. Okay. So what we can see now is that in today's dollars, okay, out the curve in 2029, we were generating $446,000 of operating cash flow, future dollars, okay? But because of our 8% cost of capital, we wound up with a discount factor of 46.32%. So in today's dollars, that $446,000 is only worth $206,000 to me. Okay, because conversely, if I deposited $206,596 today, and it grew at 8% a year for 10 years, it would turn into $446,025. Okay, does everybody understand the relationship there? Okay. So when we talk about the time value of money, let's review. Okay. We talked about simple interest. Oh, I don't want this. Go home. Okay. We talked about simple interest, where the interest does not get added to the principal every year. Okay, and you get the same amount of interest each year, right? We deposited $1,000, we get $100 per year. We get our $1,000 back. We made $300 in interest. Therefore, we made $1,300. Okay, we made $300 of interest on the $1,000 of principal that we put in. On a compounded basis, we earn the same 10%, but then the interest gets added to the principal, and then our new interest gets calculated on that new amount year after year after year after year. Okay, so we get the compounding effect of interest upon interest. And in this very simple example, we saw that on a simple interest basis, at the end we had $1,300. On a compounded basis, we had $1,331, or $31 more dollars than we did before. And then we said, all right, well, there's got to be a way in Excel to figure this out, right? So if I've got $1,000 today, what's the future value of my investment if I put that money into the market at a particular rate of return? And we said that Excel says equals FV, right? Equals future value. You open that parentheses and it begins to ask you for the different variables that it wants. Okay, it asks you for the rate. Okay, it asks you for the number of periods, the number of compounding periods. We haven't talked about payment, we'll get there. Then it asks you for the present value. Remember, there's only 4 variables in this equation: present value, future value, rate, and time. Okay, so if you're using an FV, if you're trying to solve for future value, you know you've got to plug in the other 3 variables. Okay, so Excel views present value as a negative because it sees that as cash going out the door, right? So PVs are negatives, right? So when you're using the equals FV formula, right, when you're entering the PV here, it's got to be put in as a negative. Okay. We talked about compounding and how to adjust the formulas within Excel to vary the different compounding periods. Okay, I could throw anything at you on the midterm: annual compounding, monthly compounding, trimester compounding, semi-annual compounding, and all you have to do is simply adjust the rate and the number of periods based upon the compounding. Okay, so if it's semi-annual, you adjust the rate by dividing by 2. You adjust the number of periods by taking the years and multiplying it by 2. Okay, quarters, divide by 4, multiply by 4. Okay, trimesters, divide by 3, multiply by 3. Right, to get to the different effects that compounding has on the scenario. Right. Then we went into present value. I want some amount of money in the future. Okay, what do I have to deposit today at some given rate of return in some period of time, lockup period for that investment? How much do I have to deposit today to get to that point? All right. So we know the future value. We know we want some amount of money in the future. Okay. We know the kind of return that we're going to get, and we know how much time we've got to get there. So Excel equals PV. Okay. Rate, number of periods, and then future value. And remember, future value in positive terms, because that's money coming back in the door. So Excel sees that as cash inflow. And then we said, all right, we've handled 2 of the 4 variables. We've handled FV, we've handled PV. Now we got to handle rate and time. Okay. We talked about a project. We know that a project was going to cost $2.5 million down the road. We earmarked $1 million today to move into an investment to handle the cost of that project 10 years down the road. Okay. How much return, what rate of return do I need to achieve in order to make that happen? And we used the equals rate function. And when we use equals rate, we use the time frame, the number of periods, we use the future value, and we use the present value. Okay, the other 3 variables of the equation. And then we said, finally, the last thing we want to know is how long would it take us to achieve our investment goal? We wanted a certain amount of money in the future. We had a certain amount of money today. We have a particular rate of return. How long a period of time is it going to take me to achieve this goal of investing $50,000 and turning it into $200,000 at a 6% rate of return? Okay, and we used the equals NPER formula. All right. And then we started to say, okay, if the future value is equal to the present value times 1 plus r to the t, and I have some forecast of what my future value looks like, what I care about is I want to know what those are in today's dollars, because I'm looking at spending money today to generate this future cash flow stream. Okay, so I need to know what's that future cash flow stream look like in today's dollars so that I can eventually compare things apples to apples in present value dollars. So we took that FV equals PV times 1 plus R to the T, and we rearranged things a little bit, and we came up with present value is equal to future value divided by 1 plus R to the T. Okay, and then we just did some fancy math, and we split that out, and we said present value is equal to future value times this discount factor. Okay, and the discount factor is 1 divided by 1 plus the rate to the T. Okay, so when we got to the pro forma forecast for S&S Air, okay, keeping things really simple, all right, keeping things really simple by simply saying they're going to keep some base incremental revenue consistent over the course of 10 years. Again, if you've done DCF analysis for your company, all right, you know that this is overly simplistic. You know that it's overly simplistic, right? But the methodology, that's what this course is trying to teach everyone in the class, is the methodology around how you go about getting to the present value dollars, right? We could have, like I said, we could have different growth rates over different periods of time. We could have different assumptions over different periods of time, forward curves that change the cost of goods sold over periods of time, right? But none of it would make any difference if you don't understand the basic flow. And that's what we're trying to do here, right? So we took a 5% incremental revenue, we kept it constant. We bumped up cost of goods sold, right, by the same amount because it's relative to sales. We were told how much expenses went up. We were told what depreciation was, what interest was. We calculated our new taxes, and we got a net income, and we rolled that forward for 9 more years. And we created a very simplistic 10-year pro forma for this project that was going to cost $2.5 million in today's dollars. Okay. And then we said, all right, let's figure out what those future cash flow streams look like in today's dollars. Okay. So we figured out, well, we got to figure out what cash is to begin with. Okay. So very simplistically, we're talking about operating cash flow. Okay, so operating cash flow is equal to, all right, EBITDA minus taxes, whereas the book calls it EBIT add back depreciation minus taxes. But if you do your income statement the right way, all right, you've already got EBITDA, so it's just simply EBITDA minus taxes gives us operating cash flow. Okay. Once you got operating cash flow for 1 year, you know it's going to be the same for all the years for this class. It's not going to be the same for your business, I promise. All right. And then we had to say, all right, that's a future stream of cash flows. I get it. But what does all of that mean in today's dollars? Okay. When I start to think about, is it worth my time to spend $2.5 million today to generate these present value stream of cash flows, right? Is it worth spending the money, right? So in order to determine whether or not it's worth spending $2.5 million today, you have to know what this future stream of cash flows looks like in today's present value dollars. And you do that by taking that future stream of cash flows and multiplying it by the discount factor, right? And the discount factor was 1 divided by 1 plus your rate raised to the time period. which is what we did here. We kept the base year. So in year one, 2020 minus 2019 gives us an exponent result of 1, right? In 2021, the 2021 minus 2019 gives us an exponent of 2. So we're going out to the second year of that discount factor, and so on and so forth until we get to year 10, where our discount factor is 46.32%. Okay, so in 2029, the $446,000 of future dollars is not worth that in today's dollars. It's only worth $206,596 because that's what we would have to deposit today at an 8% rate of return if we wanted to get $446,025 10 years from now. Okay? So that is time value of money and how it specifically relates to pro forma development. And I apologize that I did not see the name of the person who was asking me about the compounded growth rates for the revenue. Who was that?
That was me,
Annalise.
Annalise. Yeah.
Okay. I will make you a special midterm just for you that has a cyclical growth rate and a varying cost of goods sold based on different forward curves. How about that?
No, that's okay.
You sure?
Oh, definitely.
Okay. All right. So does anybody have any questions about the process, the flow? Because this will be, so what we just talked about will wrap up tonight's lecture. Okay? Next week, we take this to a whole nother level of detail and we start to get into net present value analysis. How do we determine whether this is a good deal or not? Okay? How do we determine whether it's worth spending $2.5 million to generate this future stream of cash flows? Right? What does internal rate of return mean? Right? What is the payback period? What's the discounted payback period? What's the profitability index? All these different metrics that we can use to determine whether or not it's worth spending our money or putting our money into a totally different investment. Okay? But it's very important that you understand how to do this before we get to next week. Okay? So the general goal between chapter 4 and tonight was to get you familiar with creating an estimate based upon a particular growth rate. Okay? What varies with sales? What doesn't vary with sales? Okay? Calculating how much external financing you need to then plug your balance sheet to force the balance, whether it's with long-term debt, whether it's common stock. There's a third thing that you can do. Anybody have an idea? It's a management decision. There's a third thing you can do. We said, okay, we want to find $648,346, right, to plug this hole. And we said, all right, we could issue more common stock. We could issue long-term debt. We do a combination of the two. But there's one more thing. We, as financial managers, there's one more thing. There's one more lever that we've got to plug that hole.
You could lower your payout ratio.
Thank you very much. If you lower the payout ratio, it lowers your dividends, which de facto raises your retained earnings, which then pumps more into retained earnings. Okay, very good. Was that Will?
Yep.
Good job, Will. Okay, so we change long-term debt, we issue more common stock into the market, or we change our payout ratio, okay, which then drops dividends, adds to retained earnings, flows directly into our balance sheet through retained earnings, increases our owner equity, and then we are able to balance out. Okay. On the midterm, I'm going to tell you where to plug it. Okay. That way, when you get to your ratio analysis, all the answers are going to be consistent with one another. Right. Okay, so we built a 1-year forecast, right? And then we got into building a 10-year income statement based upon other assumptions that we were making. Okay. To create a future stream of cash flows that we then created discount factors for. Is there a way I can add this particular Excel? Yeah, I'll put this out there on Middle. No problem. Okay. And then we calculate the present value. Okay. So now we've got an easy way, and this is just kind of a prelude for next week. Now we've got some 10 years of future cash flows, right? Brought into today's dollars that we're going to be able to compare to how much the project costs today, right? We're looking at shelling out $2.5 million, right? Cash outflow in order to generate cash inflow, right? Is it worthwhile to do so, right? And that's where next week will come in. We're going to do project analysis. How do we choose one project over another? Or how do we reject all of the projects, especially if they're mutually exclusive to one another, right? So this was the time value of money as it pertains simply to getting Excel to do the work for you, understanding the relationship between present value, future value, rate, and time, okay? And then taking all of that information and building out an estimate for a future stream of cash flows. Okay. Anybody have any questions? Okay, so tonight, so one of the things I'm gonna start doing this week, and it hasn't really been necessary up until this point because we've been doing the mini cases and the data detective simulation, which has been reinforcing the content, right? I'm gonna be putting some time value of money calculations up onto Connect for homework assignments for next week, okay? So now it's kind of that time we're gonna start getting into using Connect for some of these exercises from week to week. All right, so next week we're going to talk about chapter 6 and we're going to talk about chapter 9. All right, so just like we did tonight where we're using Excel most of the lecture and we didn't really get into any PowerPoint, we're going to pretty much be doing the same thing next week, and we're going to get back into Tasha's Toy Emporium and looking at building a pro forma for her business and looking at some investments that she's looking at making, and how do we go about helping her choose between one project or another. Once we get through that, okay, you're going to have a very, very, very clear idea of what the Heritage Doll case is all about, right? So next week, chapter 6/9, basically in Excel like tonight. And then next week, after we do that, we're going to break into the Heritage Doll case, and I'm going to have the Excel files ready for you that deal with pro forma analysis around the two different scenarios that the Heritage Doll Company is looking at implementing within their business. Okay, so we're kind of building right into the midterm and getting that Heritage Doll case going, right? So after next week, the following week is our midterm. Right, so everything we will have talked about from the beginning of the semester up until next week, where we get into net present value analysis, IRR, payback, profitability index, that will all be what's covered on the midterm exam, okay? And it'll be a case study, and literally it is going to be essentially what you did with the S&S Air, okay? And then what we did tonight, building out a pro forma, and then what we're going to do down here next week. Okay, and once we get through that, right, you will have all the tools that you need to begin working on the valuation for the Heritage Doll case. Okay, and we'll get into what the assignment is going to look like for that when we get together again next week. Okay, I love this stuff. Like this is like my most favorite thing to do in terms of when I was dealing with mergers and acquisitions. I loved DCF analysis. simply because there was always so many different assumptions. Like Annalise, you said, you could always find some different assumption, to plug into your pro forma, that was very difficult for people to challenge until it went all the way up to the board and they said, yeah, we're not dealing with that assumption. And then they just rip it out. Any questions? Okay, I will put, I'll get this Excel file put up on Moodle as well. The Connect homework will be posted tomorrow, right? That'll be due by next Monday. And then, again, read the slides, go through the slides. Everything that's in the slides is what we talked about tonight. I apologize that my iPad was being a little bit wonky. It's the first time it's done that. Otherwise, I would have been able to share my screen so I could write on the screen with you guys. But the formulas are in the PowerPoint deck. But everything that's in there is what we talked about through the examples that we worked through tonight. Okay. Any questions, comments? No? Okay. All right. Have a great rest of your week. And I'll be posting the lecture recording up to the YouTube channel. It'll probably take a little while for it to process, so it'll probably be up there tomorrow if you want to go back and review. Okay, if you've got questions, feel free to call me, text me, email me. I'm happy to set up some one-on-one time if there's something we need to go over. All right. Have a great night, guys.
Thank you.
Thank you.
Cheers.
Yeah.